This split-screen chart compares the S&P 500 to a single private portfolio between 1966 and 2012. On the left, the market reacts to the decoupling of the dollar from gold, double-digit stagflation, and two technological bubbles. On the right, the portfolio maintains a smooth, compounding trajectory across those same decades. The efficient market hypothesis defines the stock market as a system where prices always reflect all available information. Under this mathematical framework, consistently extracting excess returns, alpha, over half a century falls into the category of statistical impossibility. This statistical rule was broken by a capital allocator in Omaha. He seized control of a failing New England textile mill worth $49 million, halted the looms, and redirected its capital to build a $144 billion conglomerate. The longitudinal evidence for this performance is documented in real time. Over 46 years, Fortune magazine recorded the specific decisions and proofs governing Berkshire Hathaway's growth. We can reconstruct this outperformance by tracing three specific developments: the mechanics of his early partnership, the 1977 mathematical thesis on inflation, and the permanent capital structure he used to insulate his holdings from market volatility. This methodology avoids complex algorithms or high-frequency systems. It relies on a framework Buffett describes as simple, old, and few. Omaha, Nebraska provided a geographic buffer from the daily noise and institutional incentives of Wall Street. In 1966, the benchmark for institutional capital was A.W. Jones, a sociologist who established the hedge fund as a legitimate investment vehicle. Jones used a mechanical leverage model. He would take $100,000 in equity and margin it to reach $150,000 in total capital. He calculated risk using velocity ratings, placing $110,000 in long positions while using $40,000 in shorts to hedge against a market decline. Between 1960 and 1965, this structure returned 325%. However, the complexity favored the manager. Investors paid a flat 20% of all profits and performance fees. The Buffett partnership used a different structure. He ignored short hedging, concentrated capital in undervalued businesses, and only charged a 25% fee on profits that exceeded a 6% hurdle. From 1960 to 1965, his partnership returned 334% gross. In 1969, with $100 million under management and a record of consistent outperformance, Buffett liquidated the entire partnership and returned the capital to his investors. He viewed the late 1960s as a period of speculative excess. His exit demonstrates a strict adherence to intrinsic valuation. He refused to deploy capital when market prices diverged from his mathematical models. During the 1970s, as inflation accelerated, the consensus on Wall Street held that equities were a natural hedge. The logic suggested that because stocks represent ownership of physical assets, their value would rise alongside the price of goods. Buffett's 1977 thesis challenged this. He proved that stocks actually behave like perpetual bonds. This graph shows the historical data. Regardless of the inflation rate, corporate America's return on equity remained tethered to a 12% ceiling. He identified this fixed return as the equity coupon. High inflation creates a structural problem for this 12% coupon. To maintain real purchasing power, a company must force its return on equity above that 12% ceiling using 5 theoretical levers. Lever 1 is turnover. During inflation, LIFO accounting causes nominal sales to rise sharply. However, as this balance sheet shows, physical volume remains flat. Corporations process more expensive dollars without increasing their actual output. Levers 2 and 3 involve increasing leverage, but rising inflation makes debt more expensive, while unbooked pension liabilities act as a massive unrecorded debt. Between 1955 and 1975, the average equity-to-asset ratio of the Fortune 500 dropped from 63% to 50%. Lever 4 is the tax rate. Buffett defined government as a Class A shareholder that claims a significant portion of earnings without ever contributing capital. Lever 5 is the profit margin. FTC data showed that pre-tax margins actually contracted from 8.6% to 8% over the previous decade, as labor and energy costs rose alongside prices. This formula summarizes the reality for the 1977 investor. A 12% return on equity, minus capital gains taxes and 7% inflation, leaves exactly 0% in real purchasing power gain. Inflation functions as a capital-consuming tax. It forces companies to use all their retained earnings just to maintain their existing physical volume, which halts the investor's ability to compound real wealth. Buffett applied this anti-inflation framework to the endowment of Grinnell College, testing his concentrated value model in an institutional setting. Most institutional endowments averaged a 1.7% median return during this period. Grinnell, using a concentrated strategy managed by Buffett and Joe Rosenfield, generated an annual return of 16.2%. They achieved this through a fat pitch strategy. Their first major bet was $300,000 in convertible bonds from Intel founder Robert Noyce. This single position eventually provided a 46-fold return. Their second bet ignored standard diversification rules entirely. The endowment purchased an entire operating business, television station WDTN. They used $2 million in equity and borrowed $11 million to complete the acquisition. WDTN was a cash-flowing asset that required little capital to maintain. In 1980, Grinnell sold the station to Hearst for $50 million. This outperformance suggested that institutional success relies on abandoning mandated diversification in favor of concentrating capital in misunderstood, high-conviction assets. By the late 1980s, Berkshire Hathaway had matured into a permanent capital architecture. Buffett operated the firm using two distinct engines. Engine 1 is Buffett the manager. Berkshire acquires wholly owned, cash-generating companies like the Sainted Seven. He grants these management teams total autonomy, allowing them to focus entirely on operations while they send their excess cash to Omaha. This engine is exceptionally resilient. During the 1987 market crash, Berkshire's internal businesses generated $215 million in after-tax operating earnings, unaffected by the chaos on the trading floor. Engine 2 is Buffett the investor. He deploys the cash from Engine 1 into fractional shares of public companies. During this period, under the influence of his partner Charlie Munger, Buffett shifted away from buying cheap, dying companies and focused instead on acquiring high-quality franchises at fair prices. Following the 1987 crash, he applied Munger's qualitative focus to Engine 2, deploying $1.3 billion into Coca-Cola. He identified the company as a dominant consumer monopoly. This diagram shows the internal compounding of that position. Because Coca-Cola used its own earnings to buy back shares, Berkshire's ownership grew from 7.8% to 8.9%, without Buffett spending a single additional dollar. This dual architecture creates a closed wealth loop. Wholly owned subsidiaries provide the capital to buy elite equities, which then internally compound their own value. This reliance on management integrity was tested in 1991 during the Salomon Brothers Treasury auction scandal. The scandal highlighted a massive asymmetry in risk. While the rogue trader responsible for the illegal bids faced a $30,000 fine, the shareholders, including Berkshire, absorbed a $290 million penalty. Buffett stepped in as CEO for 10 months to prevent the firm's total collapse. He worked directly with regulators to preserve the firm's ability to trade, effectively saving the investment from total loss. The crisis confirmed that mathematical models are secondary to management integrity. Capital allocation at this scale is ultimately a bet on human reputation. The 46-year record from 1966 to 2012 functions as a completed macroeconomic experiment. It provides longitudinal evidence validating a singular financial philosophy across cycles of extreme inflation and technological change. This 2011 taxonomy of capital summarizes his findings. He categorizes gold as a barren asset and bonds as a risk to purchasing power. He identifies the only reliable source of long-term wealth as the ownership of productive assets like equities and land. The fusion of Benjamin Graham's valuation discipline with Charlie Munger's focus on dominant franchises allowed Berkshire to scale from a dying textile mill into a $144 billion powerhouse. Buffett's final capital allocation addressed the limits of generational wealth. He engineered the transfer of his entire fortune to global philanthropy, primarily through the Bill and Melinda Gates Foundation. These 46 years of data demonstrate that the market can be systematically beaten. It requires an allocator to remain rational, Ignore macroeconomic noise and focus exclusively on the compounding power of productive assets.